All right, this is Ubaid on behalf of V Electronics, and in this video, we're going to be talking about bank management principles. Okay, more specifically, we're going to be talking about three types of different principles. Okay, number one has to do with liquidity, so we're talking about liquidity management. Number two has to do with your equity or capital, so capital management. And number three has to do with profit, so it has to do with your asset management. So asset management. So let's start off with liquidity. Now, when it comes to liquidity, yeah, we're talking about um, having enough in reserves, okay, to pay for things like liabilities, for example. Okay, so this is liquidity. All right, so liquidity has to do with cash flowing in and cash flowing out. Okay, so cash flowing in should be more than cash flowing out. Okay. One reason why it should be more is to take care of any unforeseen events, such as emergency expenses. Okay, so this is an emergency. Okay, one such emergency that I can think of would be, say, for example, changes in economic condition. Okay, so if there is an inflation for whatever reason, okay, like we noticed back in 2007 when the economy went stagnant and people weren't able to afford their mortgages. Okay, banks who lent subprime mortgages, okay, they had emergencies of their own, okay, because these borrowers they basically defaulted, okay, on these subprime mortgages, which means they went bankrupt. As a result of which, banks eventually went bankrupt. Okay, now to solve this problem, okay, to manage this risk, okay, you have to manage liquidity. And to manage liquidity, one way to manage liquidity is to have enough in reserves. Now, obviously, banks do have a certain amount of reserves, okay, as required reserve. Um, and the central banks or the governments may decide as to what the required reserve should be for commercial banks in the country. Okay, however, for a bank, especially if the bank foresees an economic disaster up ahead, okay, they will need to hold more in their reserves than their required reserves. Okay, so when it comes to reserves, okay, banks will need to have access reserves, not just required reserves. And these access reserves will take care of any unforeseen events. Okay, so required reserves. Okay, we all know that banks they borrow short and they lend long. Okay, what does that mean? So when we deposit money in a bank, the bank uses that money to give out loans and mortgages. Right? Now we may need that money right away, which means obviously that deposit is short term, is temporary. Okay, as a result of which banks they borrow short. They borrow short from depositors like me and you, and they lend long to people who need money, to borrowers. Okay, like me and you. Okay, so that has to do with loans and mortgages. Mortgages will take you about 20, 30 years to pay off, which means all that time that you're paying off your mortgage, the bank is making money off that mortgage in terms of interest. As a result of which, okay, if the depositors they start withdrawing their money, okay, bank does not have enough money to lend as loans and mortgages. This is if there is an economic disaster. Okay, what's going to happen in a recession, for example, or during an inflation? Okay, people may want to start withdrawing their money. All right, especially if the interest rates are not too high. Okay, people will start withdrawing their money because the opportunity cost is low. Okay, when it comes to withdrawing money. All right, it's more profitable to keep money in your wallet than in the bank. Because if the bank defaults for whatever reason, let's say the bank closes down sometime in the future, okay, the depositors will lose their money, right? So that's the idea behind liquidity management. This is liquidity management. Cash flowing in should be more than cash flowing out. You need to have more in reserves, as a result of which, okay, banks will need to arrange those reserves from somewhere. Okay, maybe they will need to borrow from other banks. Okay, this has to do with your federal funds rate. Okay, or maybe they need to borrow from the central bank, which has to do with your federal discount rate. Okay, either ways, okay, they will need to increase their lending activities in order for them to have more in reserves. All right, so this is liquidity management. Now, the second type of management or second type of bank management has to do with asset management. And this has to do with profit. And what exactly is asset management? So when you sell an asset, let's say for example, this is um, say for example, the bank is selling an asset or lending money. Okay, when you sell an asset as an individual, okay, you want to make sure that that sale is more than the cost of the liability. Okay, which means if you bought that asset from somewhere, okay, you want to make sure the cost price is less than what you're going to receive when you sell that asset. Okay, so if you buy this asset, okay, from XYZ, and then you sell it somewhere, okay, at a certain price, that price should be more than your cost price. Okay, and likewise, when it comes to asset management for banks, okay, if they borrow money from depositors. Okay, when we deposit money, we make money from interest, especially if you deposit that money in your savings account. Okay, now this is what the bank pays out as interest. This is their cost of borrowing money. And when they lend out money in terms of loans and mortgages, they're earning money as income when it comes to interest. Okay, this is what you're paying as interest, but the banks are making money off those loans and mortgages. So, on one hand, what they're doing is they're they're paying money to depositors like me and you in terms of our savings account, okay, in terms of the interest that we earn from the savings account. And on the other hand, they're lending money as a result of which they're earning money in interest. Okay, so it's sort of like a business. Okay, you're buying something and then you're selling something. Okay, you're buying a product, you're selling the same product somewhere else to make a profit at a higher price, which means their interest rate, okay, when they lend out mortgages and loans should be higher than the interest rates that they pay to borrowers like me and you when we deposit money in our savings account. So this is basically asset management. All right, so money from assets money from assets should be more than money earned from liabilities or money paid out when it comes to liabilities. Okay, so that's asset management, and that's the second principle when it comes to bank management. And the third principle to bank management activity, okay, has to do with capital management. So this is equity or capital. And the entire purpose of this kind of management is to prevent bankruptcy. Okay,